Let's be honest, when you first start investing, the number of options out there is overwhelming. There are thousands of ETFs to choose from, and if you don't know what you're looking at, it's easy to get paralyzed and do nothing. So today I'm cutting through all of that noise. I'm giving you the 5 best ETFs for beginners in 2026. These are not random picks. Every single one of these has a proven track record, low fees, and is beginner-friendly. And by the end of this video, you're gonna know exactly which ones make sense for you based on your goals. Let's get into it. Before we dive in, one quick thing. An ETF is essentially a basket of stocks you can buy in a single purchase. We covered this in detail in our last video, so if you haven't watched that yet, go check it out. It'll give you the foundation you need. Now let's talk about the 5. Before we get into each one individually, here's a quick snapshot of all 5 so you can follow along. Quick snapshot of all 5. VOOO. Price approximately $616, expense ratio 0.03%, average since 2010 14.31%. VTI, price approximately $331, expense ratio 0.03%, average since 2009 0.21%. QQQ, price approximately $600, expense ratio 0.20%, 10-year average 19.75%. SPY, price approximately $672, expense ratio 0.09%, average annual 10.53%. SCHD, price approximately $31, expense ratio 0.06%, dividend yield 3.61%, average since 2011 13.02%. That's your one-screen snapshot. Keep it in mind as we move forward. Next, I'll break down what these numbers actually mean for you. Now, these numbers reflect current data as of the time this video was made. Markets move every single day, so I always encourage you to do your own research and verify these figures before making any investment decisions. Links to each ETF's official page are in the description below. Now, let's break down what each one actually means for you. Number 1. VOO, the Vanguard S&P 500 ETF. If you could only own one ETF for the rest of your life, a lot of financial experts would point you to VOO. And for good reason. VOO tracks the S&P 500, the 500 largest companies in the United States. We're talking Apple, Microsoft, Nvidia, Amazon, Google, the biggest, most powerful companies on the planet, all in one fund. Here are the numbers. VOO is currently priced at around $616 per share. Its expense ratio is just 0.03%, meaning you pay $3 a year for every $10,000 invested. That's basically nothing. And since it launched in 2010, VOO has delivered an average annual return of 14.31%. If you had invested $10,000 in VOO when it launched and just left it alone, you'd have well over $60,000 today. Warren Buffett himself has publicly said that when he passes, he's instructed his estate to put 90% of his wife's inheritance into an S&P 500 index fund. That's the level of confidence the most successful investor in history has in this type of fund. VOO is your foundation. It's the anchor of a beginner portfolio. Number 2. VTI, the Vanguard Total Stock Market ETF. Think of VTI as VOO's bigger brother. While VOO holds 500 companies, VTI holds over 3,500, essentially, the entire US stock market. Large companies, mid-size companies, small companies, all of them in one fund. And VTI is currently priced at around $331 per share. Same expense ratio as VOO at 0.03%, and its average annual return since launching in 2000 is 9.21%. Now that sounds lower than VOO, and you might be wondering why. It's because VTI launched right before the dot-com crash, and that devastated returns in its early years. Over the last 10 years specifically, VTI has returned around 14% annually, very much in line with VOO. The difference between VOO and VTI is really about how broad you want to go. VOO bets on the biggest 500. VTI bets on America's entire economy. Both are excellent choices for beginners. Honestly, you cannot go wrong with either one. Coming in at number 3, we have QQQ, also known as the Invesco QQQ Trust. If VOO and VTI are the reliable workhorses of your portfolio, think of QQQ as the high-performance sports car. QQQ is where things get a little more exciting and a little more volatile. This ETF tracks the NASDAQ 100 index, which represents the 100 largest non-financial companies listed on the NASDAQ stock exchange. The exclusion of financial companies like banks and insurance firms is key. It concentrates the fund in other sectors, most notably, technology. In plain English, QQQ is a tech-heavy fund. We're talking about the giants, Apple, Microsoft, Nvidia, Amazon, Meta, Tesla. These are the innovators and disruptors that have fundamentally reshaped our world and driven a huge portion of the market's gains over the last decade. So, let's look at the numbers. QQQ is currently priced at around $600 per share. Its expense ratio is 0.2%. While that's higher than VOO and VTI, it's still very reasonable. For every $10,000 you invest, you're only paying $20 a year in fees. Now, here's the number that gets people excited. Over the last 10 years, QQQ has delivered an average annual return of 19.75%. To put that in perspective, that is significantly higher than the S&P 500's performance over the same period. But, and this is a very important but, you need to understand the fundamental rule of investing. Higher potential returns almost always come with higher risk. Because QQQ is so concentrated in the technology sector, it's more susceptible to swings. When tech stocks are soaring, QQQ flies high. But when the tech sector gets hit, like it did in 2022 when QQQ dropped over 30%, it drops hard and fast. This is why QQQ is best used as a growth-focused satellite in your portfolio, not the core. It's a powerful tool for boosting long-term growth, but probably not something you want to hold by itself as a beginner. Think of it as a complement to a broad market fund like VOO or VTI, not a replacement. Number 4 on our list is SPY, the SPDR S&P 500 ETF Trust. SPY earns its place on this list because of one powerful word, legacy. It's often called the granddaddy of all ETFs, and for good reason. Launched by State Street Global Advisors on January 22, 1993, SPY was the very first exchange-traded fund ever created in the United States. It was a revolutionary product that democratized investing for millions. For over 3 decades, it has weathered every storm the market has thrown at it. From the dot-com bubble to the 2008 financial crisis and beyond. And through it all, it has delivered an impressive average annual return of 10.53%, a testament to the enduring strength of the American economy. SPY is currently priced around $672 per share with an expense ratio of 0.09%. Now you might be thinking, wait, SPY and VOO both track the S&P 500, so what's the real difference? It boils down to 2 key factors, cost and liquidity. VOO is significantly cheaper, with an expense ratio of just 0.03% compared to SPY's 0.09%. That might seem like a tiny difference, but over 30 years of compounding, it can save you thousands of dollars in fees. For this reason, long-term buy-and-hold investors typically favor VOO for its cost efficiency. However, SPY holds the crown as the most traded ETF in the entire world. Its massive daily trading volume means it has incredible liquidity. For active traders who need to move in and out of positions quickly and with minimal price impact, this liquidity is paramount. The bid-ask spread, the tiny difference between the buying and selling price, is often tighter for SPY, making it the preferred vehicle for institutional investors and professional day traders who prioritize execution speed over long-term costs. So, what's the verdict? If you're a beginner focused on building long-term wealth, VOO is the smarter, more cost-effective choice. But SPY is absolutely worth knowing. Its status as the original and most traded ETF means you'll hear its name constantly as you start following financial news and market analysis. Understanding its role is key to understanding the ETF landscape as a whole. Number 5. SCHD, the Schwab US Dividend Equity ETF. And here's the one that most beginners overlook. In a world obsessed with explosive growth, it's easy to miss the quiet power of an income-focused fund like SCHD. While the other 4 ETFs on this list are primarily designed to grow your initial investment over the long term, SCHD is built for a different, yet equally important purpose: generating income. Specifically, creating a steady stream of passive income through dividends. So how does it work? SCHD tracks an index of about 100 large US companies, but not just any companies. These are businesses that have consistently paid dividends for at least 10 consecutive years. This strict requirement filters for stability, maturity, and financial strength. Think of established household names that are leaders in their fields, and because you own a piece of all of them, every single quarter SCHD pays you a dividend, meaning real cash gets deposited directly into your brokerage account just for holding the ETF. Let's dive into the numbers that make SCHD so compelling. First, it's currently priced at just $30.94 per share, making it the most accessible entry point on this list for investors on any budget. Its expense ratio is a razor-thin 0.06%, so your returns aren't being eaten away by high fees. Now for the main event, its dividend yield is 3.61%. To put that in perspective, for every $10,000 you invest, you're earning around $361 a year in passive income, before any stock price appreciation. And speaking of appreciation, since it launched in 2011, SCHD has delivered an impressive average annual return of 13.02%, proving that income and growth can go hand in hand. This combination is what makes SCHD a true wealth-building machine. You can spend the dividend cash, or you can reinvest it to buy more shares, which then generate even more dividends. This is called compounding, and it's how you can turn a small, consistent investment into a significant source of income over time. SCHD is the perfect ETF for people who want their money to work for them right now, not just in 30 years. It's incredibly popular with investors focused on building passive income streams for financial independence, and it pairs beautifully with a growth-focused ETF like VOO or VTI to give your portfolio a powerful 1-2 punch of both growth and income. So, let's bring this all together. Here's how I'd think about these 5 ETFs as a beginner. If you want a simple, rock-solid foundation, VOO or VTI, pick one and start there. If you want growth exposure to tech and you're okay with more volatility, add a small position in QQQ. If you want passive income from dividends while you grow your portfolio, add SCHD. And if you're ever talking to someone about markets and they bring up SPY, now you know exactly what it is and why VOO is the better long-term choice for beginners. You don't need all 5 of these right now, you don't even need 2. Starting with 1, buying your first share, is the most important move you can make. Here's your action step for this week. Go to your brokerage account, look up VOO, VTI, QQQ, SPY, and SCHD, compare their prices, read about what each one tracks, and decide which one aligns with your goals. Then buy your first share. Even if it's SCHD at $31, you're building the habit, and that habit is worth more than any single investment decision you'll ever make. If this video helped you understand which ETFs are right for you, hit subscribe. Every week we break down exactly this kind of content. Simple, practical, no hype investing education for everyday people building real wealth. I'll see you in the next one.